G'day, Peter here from PPA and welcome to this week's show, Building Property Investments Australia, the only place to be for real facts, real figures and real flaming hotspots. Today we're super excited because we're going to talk today about high cash flow properties. And what are the best properties to achieve this? They are a dual occupancy property. So I'm going to bring Tony on now to talk all about the ins and outs of dual occupies, and I'll come back on following to give you the numbers, the figures. Alright, so enjoy Tony and we'll see you soon.
Thanks Peter. Tony from Property Professionals Australia, and I am really excited to show you this today because right now our clients are probably doing better out of this type of property in the right location than any other design because of the outstanding cash flow. But it's not just about building a dual occupancy. It is a cash machine done correctly. Our builder knowledge and our experience and expertise in research around Australia over the last 10 years has really set us up to come up with the best designs in the best locations for the best returns. And I'm going to go into more detail about that in a minute, but first, coming back to designs, you can do a number of different designs depending on what demographic location you're in, what the demand is, what type of tenant you'll get, and what they want for the highest cash flow and capital growth. And it could be a 2 and a 3 bedroom like we've showed you here. Take no notice of the picture Peter's drawn. It reflects nothing about the quality of our builds. Just a little joke for you. But yeah, it could be a 2 and a 2, could be a 3 and a 2, could be a 4 and a 1, it could be a 3 and a 3. It depends what type of property is in the highest demand. Because, you know, predominantly people don't want to overspend on rent today. They probably never did, but they never had the opportunity to invest in one of these or rent one of these before or buy one of these. So what we want to do is be in the area where demand's the highest, and we need to talk to people on the ground to know that. Property managers, developers, builders, town planning, council, the local businesses, and we do a lot of that with our on-the-ground research we do to find what type of designs will work, what size dual occupancies will work, and then we put together the design with the drafting and estimating team for the builders that we want to build for our clients, right? Because our clients leverage off us, and the builders, we're their client, right? And we put a lot of pressure on them to do exactly what we want and give the best returns, so the best price point for our clients. And it's extremely important that's done right. That's why I'm emphasising it. They've really got the potential for high cash flow because what you're doing is building on one block of dirt, one block of land that you're paying one rates for, one stamp duty for, but two properties predominantly on that one block of land. And it's not much different when you think about it to building two properties close together. They are divided by a solid block, fire rated and soundproof wall. Soundproof to a certain degree that you will not get the noise transfer through that wall that you will through a window to the neighbour, because that's a poor insulator. The glass is always the poorest insulator in the house. Whereas this is a solid blockwork wall. It's fire rated to 1.5 hours depending on where it is in Australia, somewhere around that, and it also soundproofs it. So it's a great option, and that firewall is from the top of the concrete to the underside of the roof space, incidentally, and it goes from front to back, right, depending on the design. And again, we look for the blocks that work the best, right, for that design what we want to put on there. It's not just about any block, it's about selecting the right blocks as well. So you need to have a great relationship with developers and builders. So that's maximising the cash flow in the right demographic area. You can maximise capital growth as well in the right location where you've got, as always, we always say this, but especially with these, more mums and dads and less investors. Because don't be fooled, there's a lot of people out there flogging this type of product, but building inferior quality builds in inferior locations where there's too many. They're oversupplying the market. They're building a product that won't resell or resell very well. And it's not that attractive, to be honest, from the front, because streetscape's really important. Our designs are predominantly built to look like a big family home, right? That you could change back by putting a big opening through the living area, say, to make it into a big family home later if you wanted to. There's no reason to have to do that, but we design that forward thinking in mind so you can. And from the street, they look very nice and very appealing to owner-occupiers and renters alike, which is really important. As I said, coming back to the location, within really good quality estates, high demand for more affordable accommodation, but where mums and dads are spending much more than you to be there, driving up your capital growth potential. Because capital growth should be a big factor, a big focus. And tax as well, these things, there's so many write-offs with tax because depreciation is the highest you can get from one block of dirt because you're writing off two buildings predominantly on one block of land, so you're depreciating two houses, not one. But your building costs are a lot less because we're building two together. Does that make sense? So the building cost per square metre are better price point, but we're depreciating it at a high rate, brand new at 100% on a diminishing scale. So it's a great tax write-off. It's a fantastic cash injection for you to leverage off later to increase your income, start replacing your income and giving you something to leverage off later on, and exponential capital growth when in the right micro area. But buyers beware, as I said. I'll bring them back to you again. There is a lot of rubbish out there in a lot of areas that are oversupplied with these, and they're not in the demographic areas where demand is the highest. We want to be where there's not enough of these and demand's really high, and that will drive your capital growth much faster. Opportunities today from 470k. We're designing some of these at the moment. We've got clients that have purchased these, already rented out, around the 470 and up. 470 will get you something around a 2 and a 2 in the areas we're in at the moment, and they're in such high demand because they're near a university growing in numbers, a hospital with high demand because of the amount of contractors coming in and out of those employment at the hospital, and doctors as well, and also a Defence Force base. You couldn't get a better location, not even far from the CBD. So outstanding return on investment. Peter's going to talk more about that in a minute. It is a great returning property class to invest in, really is. Who will buy them in the future? People often say, Tony, but who's going to buy them when I do on sell it? And we always say buy and hold and let it gain capital growth for a sustainable period of time and strong returns so you can push that into, say, an offset to pay down your family home sooner. A great little strategy that Peter's going to talk more about. But, you know, there's a myriad of people that will actually be interested in buying these because they're very appealing because of their price point and design to big families that have, you know, children coming into teenage years and adult years and they can't afford their own home. They want affordable accommodation. They can live in one side, maybe the two-beddy, mum and dad still in the other side, or the grandparents or parents could live there because, you know, they didn't save enough for retirement. It's a growing problem today. So they're very attractive to those people, or professional couples that want to live in one side, rent out the other side to increase their cash flow and savings, so then they can leverage off that to build their own home or invest down the track. You know, the younger demographic are definitely taking advantage of this too because they don't want to pay so much for rent. There's a lot of different age groups and demographics of people that will buy these, and if they're built with the right design that are really appealing, they'll really rent well and they'll really sell well, and as I said, maximise your tax write-offs. So they are a fantastic property investment class to invest in, and we can't say enough if you get it right, and we certainly are getting it right today. So thank you very much for listening. Tony from PPR. I'm going to hand over to Peter to talk about those numbers. There's ever important numbers that are really exciting. Bye for now.
Thanks, Tony. Look, there's no doubt the numbers are the exciting part. That's what you invest for. You invest to make money. Yes, investing in property can be enjoyable and becomes addictive, but it's about the numbers, isn't it? So let's look at them now, okay? This is not I'm not a financial advisor. I can't give you financial advice. We have financial advisors that can give you the exact numbers for any property option we would recommend to you, so you can actually see the numbers before you move forward. But this is a good example of a client that has just purchased this property, and these are the numbers we looked at. Okay, so they purchased a dual occupancy property for $474,000. So you can do this without having any of your own savings. Yes, obviously, if you don't have your own home with equity, you need to have savings to get started. But in most cases, people are transferring some equity from their home across to the investment property. So in this case, there's a 90-10 loan value ratio, meaning 10% deposits required. So on a $474,000 property, we've got $47,400 as a deposit. Now you're not losing that equity in this property. You're just transferring your equity from this property over to this property. Okay, so now the equity's there working for you. You've turned this non-deductible debt being your own home to a fully deductible debt being an investment property. And yes, of course, there is deposit and cost to purchase a property. So on top of that is approximately $12,300 in other costs. And there your stamp duty, your conveyance solicitor fees, your bank fees, and interest during construction. So yes, and because you're purchasing a house of land, there's only stamp duty on the land only because you settle on that first. That's saving you around $10,000, which is outstanding. And okay, so let's look at the numbers. You've now got the house completed. You've rented out both sides. Now we've got rental appraisals from a number of property managers, and we've taken the average between those, and that's $690 per week as a rental income for that dual occupancy property. So you purchased a property for $474,000 and you're getting $690 per week rent. That is outstanding rental return. Where you look at most places in Australia, you're lucky to get 5% return, which means if the property was $474,000, you might get $470 a week rent. So $690 is certainly outstanding. So when we look at $690 per week in rental income, and Tony touched on before about tax, because it's a new property, it has highest depreciation, and being the fact that it's a dual occupancy, you've got 2 kitchens, more bathrooms, more inclusions, so there's more depreciable items. So your tax deductions are really strong. And with the tax withholding variation form, you get your tax back, your annual tax return back in your tax, back in your pay each week. So you add that cash flow with the rent, gives you really strong cash flow. And in this example, that equates to $200 in your pocket each week. Now, how do you get that? That's your tax benefits plus your rental income less your costs. Now, you've got your costs of your interest on the loan, your rates and water, your property management, and your insurance. When you deduct those weekly costs against with the income, you're at $200 a week in your pocket. That's $200 a week you're in your pocket. You're getting right now that you obviously aren't getting now that you can get. So you look at that over a year, that's approximately $10,000 per year in positive cash flow in your pocket. And we look at it over 10 years with inflation of around 2%. We set it out with the software, which is again conservative. That's $110,000 additional cash flow over that 10-year period in your pocket, which is obviously outstanding. So then we look at tax deductions. In the first year, you have $40,000 tax deductions. That's based on an average income and their marginal tax rate. But again, our financial advisor can get out exactly what that is for you based on your marginal tax rate. But for this example, that's $40,000 in deductions. That's not in your pocket. That's deductions. And over 10 years, that's $430K worked out to be with this personal investment analysis software we use. So that's huge deductions. Get that money. Look, most people are working, for 2 to 3 days a week just to pay the tax man. Get that tax money working for you. Start turning that around. Okay, then we look at capital growth. As again, Tony touched on how important that is, and we know that's very important. We've used 7%, because Australia's property market has grown at approximately 8.5% over the last 100 years. We've used 7% to be conservative. Also, when we say conservative, we're selecting location at the start of the property cycle, so you should get solid, strong growth over that sort of 3 to 5 years. So we'd expect higher growth in the early years, then correcting, then going to another cycle. So it allows you to have a couple of property cycles over that 10 years. At 7% growth in the first year on that purchase price is $33,000. So you made yourself $33,000 in equity growth in that first year, plus $10,000 in cash. That's outstanding. And if you look at that compounding, growth on growth on growth over the 10-year period of holding that property, because property's about buying and holding. We talk about our fast track program, which is not a get-rich-quick scheme, because property's a get-rich-slow scheme, but there's faster ways to do it, and that's what we're talking about. But you look at that over the 10-year period, that property's now at 7% compounding capital growth, now worth $932,000 for the $474,000 purchase. So that's a $481,000 equity gain you've just given yourself over that 10 years for pretty much doing nothing. I mean, yes, there's things involved, but you aren't working for it day to day. So how outstanding is that? So we look at that. All the boxes are ticked for a great investment. You get great tax benefits. You've got a capital growth driven property with all the boxes ticked for high capital growth, compounding over that time frame. High cash flow, so you get money in your pocket now that you haven't got right now, and that's compounding. That's going to increase also as the inflation and rents go up. But importantly, you want to pay your own home off, don't you? Most people that own their own home want to pay down that mortgage as fast as they can. Now we have mortgage brokers that specialise in investment funding, so they'll set up an offset against that, against your property, so your incomes can go in that offset to help you pay down the interest faster. Then you get the rents from this property, two rental incomes come from this property into this offset, plus you get your tax benefits through a tax withholding form also coming into that offset. It's going to help you pay down your home much sooner. How good is that? So you're getting your house going, you're paying your house off sooner, you're getting your capital growth, you get more cash flow, and importantly, with that additional cash flow and equity growth, you can use that cash flow and equity growth to duplicate sooner. I guess that's when we talk about fast track. You can get into the next property sooner. Like one property is a great thing to do for your investment and your investment funding. But multiple properties can help you get there much sooner, and higher cash flow can even accelerate that. So that's fast tracking your financial future, and that's what we're all about here at PPA, and quality properties as Tony touched on. So I really hope you got a lot out of today's video. And look, if you want to learn more about property investing in dual occupancies, we'd love to help you. We'd love to give you have a discovery session with you, as we say, at our fast track session. So look, do yourself a favour, contact us, make a time for a fast track session. It's not a sales call in disguise. It's all about you and the outcome you want from it, and we can tell you all about these dual occupancy properties. So that's it for today, but next week we're really excited because we're going to tell you about where not to buy. Because often people are buying when it's too late in the markets, and not only where not to buy, but what not to buy as far as properties types and models and things to avoid, and those traps that companies are out there with a lot of little schemes to get you sucked in. We're going to tell you all these so you can make sure you don't make those mistakes. So until next time, we really hope you enjoyed today's show, and we'll talk to you again soon. That's Peter from PPA, signing out.
Good, I'm glad you said Peter from PPA. I was going to say that before. Just say Peter from PPA, just to reinforce who we are.